Welcome to your Mortgage Insider update for September the 23rd. The Fed meeting has come and gone, and we got exactly what the market expected, 50 basis points. That was pretty widely expected that the Fed would move 50 basis points. And we're going to look at the charts and really hope to drive home that when the Federal Reserve cuts rates, I know that the consumers, most people just hear about it in the news, and that's the first they've heard about it. But that was expected and almost broadcasted. It was for a month that they were going to cut. The question was, how much would they cut? So we actually are going to see where interest rates have actually moved back higher after the Fed made their rate cut, and talk a little bit about how this affects you as a consumer and what to expect here in the near future, because it's really all about what's ahead. So we're going to start watching the 10-year Treasury. That is our best course of just day-to-day. Just you can look this up on your phone, on your Bloomberg or Yahoo or whatever. Good barometer, and we can see at 3.73%. This is actually up quite a bit since prior videos. So let's look at how we got here. Back on August the 5th, the Bureau of Labor Statistics gave us the jobs report. Now that was for the month of July. Initially, that came out well below expectations, and we saw that there was, the lead up to that was mostly expected there to be less jobs created, and it was actually quite a bit worse than originally thought. And we saw the 10-year had dropped all the way down to this low point of 3.663%. And then bounced right back up. So there was a little bit of a pullback over zealous markets where the jobs report was bad, but not quite as bad as really turned out to be later. So as we get into through the month of August, we'll fast forward, and now it's September. So we got the August jobs report right here on September the 3rd, and that was less than expected as well. And not only was it less jobs created, the look back to the July numbers that we originally got were all from July and June was moved down. There was actually 80,000 less jobs created, and that has really brought the bigger reaction to where interest rates have fallen, and that's where the markets were convinced that the Fed were going to cut 50 basis points at their meeting just this last week, which is exactly what they did. Now, the reaction to that, September 17th, we get the Fed chairman's speech afterwards, and he tried his best to convince the marketplace that they were so confident the economy is doing so well that they have the ability to cut 50 basis points without jeopardizing inflation. But between the lines here, what they're really saying is that inflation might be under control, but jobs are starting to become a problem. So it's going to take another jobs report this coming week at beginning of October. We'll get the September jobs report, and that could solidify the longer term view. And so if we think a little bit ahead here, markets have comprehended everything that the Feds have said. The Federal Reserve Chairman is, he had his speech, but there's also other Fed governors that have been out speaking on news. They've had speeches that get followed, and the general feeling is that they are open to further rate cuts, but they basically shut the door on it at this moment in time. They want the market to believe that they've done a one and done rate cut this year, even though their dot plot does project that in the future they're going to cut rates further. So if we think out to the beginning of October here, we could see this trend, and we can see that right today we're at the 25-day average. We actually ran into that back at the end of August, right before we got into the jobs reports in early September, and then here September 23rd, we're running into this 25-day average, and does feel like we have the ability to break further down into this level. This is the 10 years. This is not mortgages, but this is definitely the trend in interest rates. That's really easy for most consumers to comprehend. So since we don't know what the future holds, we're going to keep coming at you each week with our YouTube video. So if you haven't subscribed to this channel, feel free to just click subscribe, and you'll get the information when you want it. And we will send out our newsletters via email if you're only getting it every so often. That's because I don't put you on our weekly email because I don't think you need to hear from me that often. But if you want to further your education when it comes to the outlook on interest rates, and you want to have that more often, send me an email back. Be happy to add you, and we can just continue the weekly newsletter or the bi-weekly newsletter, as opposed to the every couple months that you might be receiving it right now. Have a great day.